Hey, it's Chris with Just for Flips. This is the first video of my notes series. Basically, I'm going to spend the next 6 to 8 weeks going through all the different things I know about notes. I know there's lots of different YouTube videos about wholesaling and all the different stuff, but understanding notes and how you can make money with notes, I think is important, especially in the current environment we're going to go into. There's going to be opportunities for subject twos, seller carries, and then how to do those, how to replace your money. So I'm going to start with, I'm a hard money lender, for those of you that don't know that. So I'm just going to start with hard money and hard money notes to start out. And how I invest my money. I invest my money in, doing hard money loans, which is a 12% return. I also sell some of those notes, and I'll explain that. But we're also going to go through buying foreclosure notes, buying notes at a discount. So on foreclosure notes, some people go buy tax liens thinking they can get the property. Generally, the tax liens pay off way before that, and you only get like a 3 to 4% return. I'm going to show you how to buy maybe seconds or thirds on properties that might be in foreclosure. You can definitely probably get those at a discount and then have an opportunity to get that property or get your money back with a great return. Buying foreclosure notes, buying notes at a discount. We're going to do talk about some gap funding, talk about, like I said, sub 2, seller carry, and land contracts, flipping notes, and hypothecation, which basically is creating notes and then getting money, borrowing against that. So the whole series should be a good one. Definitely ways to make money. We're going to start with the 12% return, but you can get infinite money on return, especially if you're getting cash flow and you have zero money in the deal. So that is what will create an infinite return. All right, so I'm a hard money lender. I start out, so whether you're watching this as a borrower or you're going to start creating your own hard money notes, you want to lend money to friends. My reel on Instagram saying, why are you keeping your money in the bank when you can do stuff like this and get 10 to 12% for your money? So let's jump into that. I'm going to share my screen. The documents that I start with my hard money loans, I loan our money, like I said, at 12%. Some of it is my money, but I do a lot of note selling. So most people don't know this. I wholesale houses as well. I can wholesale a note. So I create a note at 12%. I can then sell that at 10%. And then I get to make the 2-point spread during that whole process. Now, doesn't sound like a lot, but when you do it in volume, it can add up. We manage about $40 or $50 million. So 2% on $40 or $50 million is basically a business that creates $800 to $1 million a year in cash flow. Here is the first promissory note. You can just see up here on the top. This is the borrower's information right there. It's all kind of the main stuff is on this first page. How much are we borrowing right here? That $100,000. Who are we borrowing from? Who is making the note? And then who is promising to pay, so the borrower. In general, it's a limited liability company. It doesn't have to be, but generally it's a limited liability company. And then you have the principal sum. You can see that $100,000 for the principal sum together with my interest rate is 12%. You see that. A lot of people do this if they're not licensed to charge an upfront fee, at least in the state of Arizona. And I think it's, there's other states that have that statute as well. You charge an upfront fee, you need to be licensed. And I'm just going to go over licensing stuff in Arizona. If you charge an upfront fee, if you advertise, you need to be licensed. If you take a spread like I do, you need to be a licensed banker. So there's a difference between being a broker. A broker can originate loans and charge fees. A banker can originate loans, they can charge fees, they can also take a yield spread, which is what I'm doing. I'm taking 2% of that 12% note, and I have the ability to service that loan as well. And here's where it goes into the payment information. Payment is due on the 1st. It is late on the 5th. You can see the monthly payment is right there. So just a quick calculation, guys. If you're borrowing $100,000 and it's 12% interest, 12% interest, 12 months, it's 1% a month. So that $100,000, you get 1% a month. So $1,000 payments after the 5th on my hard money loans have a late fee of $200 or 10%. So 10% of the payment. So if the payment is $1,000, 10% of that is only $100. Now, if you borrow $300,000 from me, 10% of $3,000 is $300. So whichever is greater. So it's either the $200 in this case, if you're late on your payment, and 10% of $1,000 is $100, your penalty is $200. Now, if your payment is $3,000, 10% is $300. So it's not good to be late on a private money promissory note. Now, when you do notes for land contracts and some other stuff, you generally don't put that kind of penalty in there so steep. We do have a prepayment penalty in our notes. We don't want to put out our notes for 15 days, so we have a prepayment penalty of 30 days. You can see that right here. After the 30th day, you can pay us off, and it's just prorated interest. So if you pay us on day 35, you pay that first month, and then you pay 5 days. Obviously, I'm a hard money lender. I'm trying to get my money out. But what's great about hard money is it's relatively liquid. Your notes, my notes only last about 150 days. So that's 5 months. So the money comes in, I can put it back out. If I have something else, I can do something else with it. What's great about these notes is since they are so liquid, you can sell these notes. That's why a lot of people deposit money with me, is because the money goes out and it comes back in, and money goes out and it comes back in. And then they can decide if they have something else come up that has a better opportunity, while they just sit there and kind of keep their money relatively liquid because it's only in there, call it 5 months on average, and they can still make plans. And then generally, if somebody does need money, I can always say, hey, I've had people say, hey, Chris, grab me 500 grand or $1 million. I can take those notes and I can sell those notes to another investor, because that note investor also knows he's been with me a while. He knows that those loans go out, they come back in. He's relatively liquid as well. And then it gets into like the late payment policies, insufficient funds, the standard stuff I will show you one thing that goes with hard money loans is the default interest rate right here is 30%. So don't get in default on your hard money loans. It's very expensive. So that is the actual note. And if you're watching this and you want copies of these, you can go to justforflips.com, register as a member, and under the tab assets, you'll have my note, my deed of trust, and my borrower certificate. I also have my A to B contract, my assignment contract, all the stuff that I use for wholesaling houses as well. But since we're talking about notes, we are going to just stay with the notes. The other document is the deed of trust. Now, on a hard money loan or a private money loan, this gets recorded with the county that basically says, hey, I'm in first position on this note. So it's just the trustor, the address, the beneficiary, which would be us, we're the beneficiary, the beneficiary's address, and the trustee. I just use Fidelity National Title as the trustee. If you have to go into foreclosure process, you can substitute a trustee. That's for people that are in the deed of trust states. You guys in the mortgage states, you have a different practice. We just do a foreclosure sale. We do a trustee sale because it's a trust deed. So that's what the trustee is for, is to sell the property. You insert the address, all the legal descriptions. And this is just, kind of generic language. It shows the amount secured there. And then, this is just kind of all the language that goes for the recording of the deed of trust. Most of the information about payments and all that are in the actual note. And the note doesn't get recorded. The deed of trust does get recorded. And if you look at the foreclosure series, you can talk about lien position and all that stuff. And then we have a borrower certificate. So these are business loans. These are not there's a couple laws that was put in place after the financial crisis, Dodd-Frank, which says you can't lend expensive loans. You also need to be licensed to be a loan officer, all that kind of stuff. Now, in the state of Arizona, you are allowed to lend your own money as long as you're not charging a fee and advertising and all that stuff. So this is just a borrower certificate that basically says that this is a business loan. It's a business transaction. You're not moving into the house. What came in 2012, 13 was what's called a qualified mortgage. So a qualified mortgage means you have to make sure that the borrower is qualified to pay you back. So these notes are 12 months and under because it falls into what's called a bridge loan. A bridge loan is 12 months or under, and you don't need tax documents and all the stuff that goes along with, tax documents, bank statements, W-2s, all the stuff that goes along with that. Especially if we're lending at foreclosure sale, this has to be done in a 24-hour time frame, and we don't have time to collect all those documents in that 24-hour time frame. So we're creating a bridge loan less than 12 months, and it's for business purposes. It is not for people to buy and move into the house. And then therefore we have all this in place, people will buy these loans. We were selling these loans off to big companies before kind of the COVID times. They restructured all their stuff. There's companies still out there doing it, but we're just selling them still off to our private guys right now, charging the 12, paying the 10%. So if you're watching this, like I said, if you're watching this because you're interested in hard money loans and what you're getting into, this is what you're getting into. If you're looking to lend money to, a family flipper or anything like that, you can use these documents to secure your money. I always, always, always suggest that you just fill out the paperwork. You fill out the promissory note. You fill out the deed of trust. You can still fill out the borrower certificate. The borrower certificate is more for if you're doing it on a high level like I am. If you're just lending it to your cousin or your sister or your brother, you don't necessarily need this, but I just have it because, I'm doing a lot of loans. So that's kind of basically creating notes where you can get good returns on your money. Maybe not have it in the bank if you're scared of the bank in the current times. You're getting a good return. You're secured in first position, deed of trust on a piece of property. Generally, our loan to value is we're at 60% loan to value. We are 85% loan to cost. So if they're buying it with 20% down at a 20% discount, so it's worth 100, they're buying at 80. We'll give them a loan at 85% of that. So on 15% down on that would be another 12. So we're lending them 68 on the 100. So definitely a decent position to be in. So that is the episode 1 of Note School, or not Note School, but Learning Notes. I don't want to say Note School. I know there's a guy out there that has a name called Note School, but episode 1 of learning the ins and outs of notes. Like I said, if you need these documents, they're at justforflips.com. Hit the member button, just register, and you can get these for free. Thank you.